It is my pleasure to introduce Yves Siegel of Siegel Asset Management Partners with his presentation, Energy in Transition, a Bullish View. I would like to remind everyone that today's call will be recorded, and if any questions should arise, please enter them into the chat. With that, Yves, the floor is yours.
Well, thanks, Paul. Are you able to put up the slides?
Doing that right now.
All righty. Good morning, everyone, and thank you very, very much for joining us today. And here we go. The call is being recorded, and my contact information is on this slide. Paul, if you go to the next slide, please. This is just some of the topics we'll be covering today. We'll start with the key takeaways. Highlight the fact that energy has done extraordinarily well in 21 and has gotten off to a great start in 22. We think the wind is at the back for traditional energy companies. Importantly, I think the narrative and sentiment is improving, and then we'll end with a brief Q&A. We will be strict and keep the call to 30 minutes. I really do appreciate everyone's time. Let's go to the next slide, Paul. I also want to thank Elko. I'm a sub-advisor for Elko Management, and it's been a great collaboration thus far. So thank you to the Elko team. If we go to slide 4, I just wanted to get my picture up there. Let's go to slide 5. So here are the key takeaways from today's presentation. Number one, again, energy was the best performing sector in the S&P last year, and we think good times are still ahead. The second key takeaway is that clean energy has strong momentum. It's gaining market share, but we also want to highlight that oil and gas is going to stick around for decades to come. The third point is that the market has been rocky, primarily because of concerns about inflation and higher interest rates. We actually think that's good for energy because we are seeing a rotation from growth to value. And again, the last key takeaway is the narrative for traditional energy is improving. If we go to the next slide, one more. And what happened in 21, the S&P energy sector was the best performing sector. You can see generating return of just over 54%. S&P had a great year as well, was up or generated a total return of just under 29%. You can see on the slide, midstream did well with a 38% return. Utilities lagged, but still impressive 18%. And then the S&P Global Clean Energy Index was down 23%. Just a few things to highlight here. Even though S&P, the clean energy was down 23%, it was up over 138% in 2020. So it gave back a bunch, but still is up if you look over the last couple of years. The other thing I'd like to highlight is that the midstream had a great year, but still trailed the overall energy sector. And you might be curious, why is that? And it's really the E&Ps or the upstream. Within the S&P 500, the E&Ps were up 86%. And why would that happen? Well, for two primary reasons. One is you have the direct exposure to higher commodity prices. Oil and gas. Oil was up 55% last year. Gas was up 47%. And the other is that the upstream oil and gas sector is paying a competitive dividend. So if you were looking for commodity exposure and looking for yield, the upstream was a good place to be. And then if you look at our portfolio, we generated a total return of 31%. We handedly, beat our benchmark But again, we underperformed the total return of the energy sector, but that's reasonable because we're all about adjusted risk returns. And the way we do that is having a balanced portfolio. So the utilities and the S&P sort of weigh down our performance. Let's go to the next slide. It is a great time to invest, in energy. As I mentioned, the S&P has gotten off to a rocky start, has recovered a little bit, but still is down for the year. Energy is just rocking and rolling. Again, it's being led by the upstream oil and gas sector, but midstream has done well. Utilities are lagging, and the clean energy stocks continue to face headwinds because of higher interest rates. But we do believe that the fundamentals for energy is quite strong. We expect commodity prices to remain constructive. We are looking for production growth. In the U.S., we think oil production can grow about 5%. Gas production can grow 2 to 3%, which is favorable for midstream that essentially moves the commodity. The export market is very strong. Investors should recognize that the U.S. is an export powerhouse. In terms of natural gas, we see extraordinarily fast growth coming from the water. The liquefied natural gas is growing strongly. We exported 6.5 BCF a day of gas in 20. That grew to 9.8 last year. This year, we should see that grow to about 11.5 and then even higher to 12.1 in 23. And that's looking at the EIA's statistics. But the point here is that we have a strong LNG market. We also have strong growth in exports going to Mexico. And I'd be remiss not to mention that the financial positions of these companies across the energy value stream are quite strong. Balance sheets have been repaired and as strong as I've ever seen them. And these companies are generating free cash flow. Valuations are attractive, albeit midstream or looking at the upstream. Again, we primarily focus on the midstream. If you're concerned about inflation, energy is a good place to be. Again, in the midstream, most of the income is protected by cost escalators. And the chart on the right shows how there has been a rotation from growth into value. The value stocks have been underperformers for the past decade, but that has changed over the last few months, and that makes a lot of sense because in a rising interest rate environment, that's going to hammer growth stocks more than value stocks, because growth stocks pretty much, if you think about it, the earnings, the value of the company is predicated on significant earnings in the future, that when that's discounted to the present, in a rising interest rate environment, you're going to have lower valuation. Whereas companies that are generating a lot of earnings today will not be that impacted by higher interest rates. So we think the rotation into value will continue as we go through the year. Let's go on to the next slide. Just to highlight favorable fundamentals, even with inflation grabbing the headlines, U.S. GDP is still expected to grow around 4%. That's good for energy consumption. Commodity prices are at least oil prices are at 7-year highs. Right now, oil is hovering around 87. Natural gas prices, nothing like a good cold spell, are up as well, perhaps approaching $5. And we see a fairly balanced supply and demand outlook. Let's go on to slide 11. Okay, this is the mega trend. There's just no way of getting around it. Decarbonization continues to gain momentum, and there's a tremendous amount of support both public and private. Under the Biden administration, the U.S. is now again part of the Paris Agreement. The strong government support for clean energy with tax incentives. The transition to net zero is as a high priority among countries, and you can see here that the vast majority of countries have signed on to climate pledge to get to net zero. Some of the world's largest public companies have jumped on board. The analogy that we like to use is that the decarbonization train has left the station, and we don't see that train going back. However, we do think that train is going to have some delays along the way. There will be the net zero goal is really predicated on new technologies coming to fruition, and that's something that we'll see if that happens or not. But in the meantime, what's clear, and you can see this on the chart that I apologize for being a little bit small there, but you could see it that renewables, primarily wind and solar, are growing rapidly and gaining tremendous amount of market share. Right now, renewable energy commands just over 20% of the electricity generated in the US. That should double by 2050 to 42% market share. But don't lose sight of the fact that natural gas continues to grow, although its share of the electricity market might shrink from 40% to 36%. But clearly, natural gas will be part of the picture going forward. And I'd also mention that we are still burning coal. Last year was a record year for coal consumption globally. So for those folks that think that fossil fuels are no longer needed, I beg to differ. And the other source of power that I'd highlight is nuclear, and that's gaining a bit of resurgence. That's a clean, generating, net zero carbon emission source of energy, and I think we'll see renewed interest in nuclear as we move forward. I just want to mention quickly the technologies that need to be developed. Hydrogen, carbon capture. Carbon capture is here. The big question is just how expensive is carbon capture, and we'll see what kind of government support we would get for that. And then renewable natural gas, and we actually own a renewable natural gas company in our portfolio. And what's renewable natural gas? That's essentially the methane that's emitted from landfills or agriculture are captured and essentially are pipeline-ready natural gas. A quick word on hydrogen. That's probably well into the future in terms of using as a source of power. But I'd like to highlight on this slide that when you think about these emerging technologies of carbon capture, hydrogen, renewable, guess what? The midstream infrastructure companies that are in place today are going to play a major role in the decarbonization moving forward. Let's move on to slide 12. And I think the energy crisis that we saw in Europe and Asia, the freeze that we had in Texas back in February of last year, all highlight the fact that we need fossil fuels. That renewables today just can't support the energy needs of today, and we need fossil fuels as a critical source of energy. The problem is that there's been a significant underinvestment in oil and gas over the last few years. About 50% of the amount that was spent in 2014 So, you can't necessarily have it both ways. There's a tug of war between decarbonization, getting to net zero on the one hand, but the other hand, it costs money. I mean, and what the world wants is cheap, affordable energy, and most important, reliable. And we need both. We need both the clean energy of tomorrow and the fossil fuels of today. Let's go to slide 13 if we could. And natural gas is definitely part of the solution. Again, it's abundant, affordable, reliable. Boy, the natural gas industry has been saying that for years. And by the way, it's still true. When you think about the goal of reducing carbon emissions, converting from coal to natural gas is one of the easiest ways to do it. And as I mentioned earlier on, we've had record use of coal globally. If we start using natural gas globally to switch from coal, we go a long way to decarbonization. And who's the major beneficiary of exporting natural gas? Well, it's the U.S. And by the end of 2022, the U.S. will have the largest LNG export capacity in the world, surpassing Australia and Qatar. The chart on the right shows how export capacity has grown and will continue to grow through 22. And then there'll be a couple of years before we have some more export capacity coming on stream. The way that we invest in the LNG export thematic is through a company called Cheniere Energy, which was actually one of the best performing stocks in our portfolio last year. Let's move to slide 14. I think this is really an important slide. The bottom line is that if you want to get to decarbonization, you need the energy companies of today, and the energy companies of today are investing in clean energy. One of the thematics of today is the ESG movement, environmental, social, and governance. And the midstream companies today are very much becoming ESG friendly. They're embracing it. They're investing directly in clean energy. One of the companies in our portfolio, Enbridge, one of the largest infrastructure company in North America, about 5% of their income is being comprised of renewable energy. They're investing significant dollars on offshore wind. And as I mentioned before, too, companies are looking at repurposing their pipelines to be able to, in the case of hydrogen, to transport hydrogen. I had another thought on this path to clean energy, and honestly, it just went in and went out. The other thing to think about in terms of the midstream companies are that they have very much embraced financial discipline, generating significant amount of free cash flow, and that free cash flow is being used to accelerate dividend growth, buying back stock, and making niche acquisitions. The key takeaway, I think, on this slide is that the midstream companies are participating in the thematics that is driving the market today, which is they are investing in clean energy. They are as well embracing ESG. Let's move on to the next slide if we could. Valuations are compelling, and there's two highlights here. If we look at the left, we have a slide of midstream valuation, and you can see here that enterprise value to EBITDA, midstream is still trading about 2 times below its 5-year average. And if you look at the right, I'm not sure if you can see it that clearly, but the energy sector is still well below its peak that occurred in May of 2018. So roughly about 15% below its peak. The S&P 500 is up 63% since May of 2018. As I said, the energy sector is 15% below where it was. Oil prices back in May of 15 were $71.50. Today, oil prices are over 87 when you look at WTI. Natural gas prices back in 18 were below $3. Today, natural gas prices are approaching $5. The midstream companies are essentially flat to where they were in 2018. So the punchline here is that energy still has a way to go. If I mentioned the midstream valuation metrics. If you look at the E&Ps, the energy sector as a whole, the PE multiple there is about 10 times, and that's about half of what the PE multiple is for the broader market. So I think the energy sector still provides a nice potential stock market appreciation. Let's go to the next slide, if we will. And for me, this is sort of my favorite slide, because sentiment ultimately drives stocks. And the sentiment for energy has been so negative for so long, but that's changing. And one of the ways that you can see that is just quotes from two of the most influential market participants. One is Larry Fink, the CEO of BlackRock, that has over $10 trillion of assets under management. In his annual letter to CEOs, we just take a quote here: "To ensure continuity of affordable energy supplies during the transition, traditional fossil fuels like natural gas will play an important role for both power generation and heating." Incredibly strong statement. And then you have Ray Dalio, who's the founder of the world's largest hedge fund, Bridgewater Associates. He said, "Thank God for the oil producers because they are providing the reliable supply." He said that at a recent panel. One of the thoughts that I have is, so much of this is being driven politically, but if you took a poll of the population and you asked them, are you in favor of decarbonization, of reducing carbon emissions? I think the likely answer would be yes. But if you ask them the question, how much are you willing to pay for decarbonization, you might get a different answer. And that just comes back to the point that we need reliable and affordable energy. And, the last bullet here is that I think the global energy crisis, the inflation, and that companies, and here I'm thinking about the energy companies, they are more forcefully demonstrating their commitments to reducing emissions. I think that is definitely helping the rhetoric towards traditional energy companies. And momentum investors, I think are likely to hop on board. And the last thing that I would say, in this regard, energy had shrunk to below 2% of the S&P. So for a lot of portfolio managers, for a lot of generalists, investing in energy was inconsequential. But today, with the growth in energy stocks, it's becoming a higher percentage of the S&P, approaching around 4%. And it's hard for portfolio managers to ignore the returns that energy is generating, the 55% last year. So from just from a strict performance perspective, I think portfolio managers can no longer ignore the energy sector. Let's move on to the next slide. So I'd be remiss if I didn't mention risks. I was in Texas last week, and I asked the energy company CEOs, what worries you the most? And the consensus was bad policy. And so the major risk here is bad policy decisions. And then the other risks that we have laid out, of course, pretty much boilerplate. But I think what concerns me the most probably would be potential for a recession and just a large stock market correction. But within that, I think energy still would hold up well with a broader stock market correction. Let's move on to the next slide. Our conclusion. Our conclusion is pretty simple. Invest in energy. Free cash flow generation is a major positive for the sector. I think the companies have gotten the message. They need to be good stewards of capital, and it's not necessarily because a light switch went on. It's because investors have essentially told the management teams, and they've gotten the message. The third bullet here, I think is equally very important. The energy transition, clean energy is a mega trend. It's not going away, and it can't be ignored. And the energy sector, has recognized that, and they are running their companies and investing with clean energy, ESG, in consideration. The one thing that I think I'd like to highlight here as well is that the energy companies also recognize that they need to have acceptable returns on capital, and that's really important. So they're going to be measured in terms of how they invest in clean energy, and I think that's a good thing. And I think when you think about sustainability, that's really important, because if you want to invest in sustainable companies, you want to invest in companies that are investing shareholder money with an eye towards generating good returns on capital. And then finally, valuations matter. I think the yields are attractive, 6 to 9%. Cash flow multiples are reasonable. We invest in utilities. We like utilities as defensive stocks. And here too, the valuations appear attractive. And, we are investing in clean energy stocks, but we are mindful that you need to be careful in terms of, or selective in terms of how you invest in clean energy stocks, especially with the headwind of higher interest rates. Paul, if we go to the next slide. This is a shameless advertisement for what we do. Infrastructure income strategy, we think offers a way to, number one, participate in the positive fundamentals for the energy sector as overall, but also dipping our toes into renewables in a very manageable way. And I think our returns in 21 sort of justified that we generated really good returns, but we still had some exposure to wind and power. The current yield is 5%, and we believe that income can grow around 4%. The ESG infrastructure strategy, which is a new one, the difference between the two strategies is here we're trying to weight clean energy a little bit more. So we have a lower yield of 3%, but potential for higher appreciation. But again, too, I want to emphasize that we're doing this in a very measured way. Top of mind for us is capital preservation and managing risk. Paul, next slide.
That's it.
Is our disclaimer. So with that, if there are any questions, I would love to take it. I know I ran a little bit long, though.
No, Eve, thank you for that. I believe it's a very timely presentation. We do have a few questions that have come through. First, we'll start. If you could please describe your portfolio allocation for the two strategies.
Yeah, let me go through those quick. Since we have it on the slide, um, on the infrastructure income strategy, about 65% of the portfolio is in midstream. Then the balance is between utilities and what we call clean energy or renewables. But even there, the utilities that we invest in are the guys that are moving toward clean energy, where they're essentially switching from coal to natural gas. And then on the clean energy side, we're investing in yieldcos, and those are companies that essentially sell power to utilities, clean power to utilities under long-term commitments that are 20 years. So, and those companies yield about 4%. What we like about them, they're sort of like where the MLPs used to be. And we see visible dividend growth of anywhere from 5 to 15%. The poster child there is NextEra Energy Partners. And then the ESG infrastructure strategy, there, midstream and utilities represent 50% of the portfolio. Then the other 50% of the portfolio is the yieldcos. And then we're limiting the pure play clean energy companies to less than 20%, recognizing that the valuations are somewhat rich.
Eve, next, you have the current yield of the portfolios here on this slide. Maybe you could talk about the degree of safety of that income stream.
Yeah, I feel really comfortable of the stability and outlook for growth of the dividends, primarily because these companies are generating significant amount of free cash flow. They cover the dividends about 2 times. Cash flow covers the dividends about 2 times, and the balance sheets are quite strong. So I feel really good about the growth and dividend outlook for the portfolio.
Okay, next, a macro point here. Well, what do you see as the possible impact for the energy sector if Russia invades Ukraine?
I think the knee-jerk reaction would be for commodity prices to go up, although somebody can make an observation that maybe oil prices are embedding some geopolitical risk premium. But I think the knee-jerk reaction is maybe the stocks go up, commodity prices go up, but I'd be a little bit cautious, use the Wall Street adage of buying the rumor and sell on the news, because I think the likelihood of Russia cutting off supply is probably low. But if that were to happen, clearly that would put pressure on natural gas prices. Russia accounts for about 40% of natural gas going to Europe. Ukraine is about 30% of, or about a third of the gas goes through Ukraine. So about 12%, if you will, of gas is supplied by Russia. Oil prices probably go up too, because under the scenario that Russia does invade Ukraine and you do have a shortage of natural gas, then all of a sudden you probably would see more oil being consumed, and that might very well put upward pressure on oil. And in fact, that's what happened this past fall when you saw gas prices and gas prices move up in Europe.
Next here we have, what's the possibility, it's a 2-part question here, Eve. What's the possibility of the U.S. banning oil and natural gas exports as a way to lower prices? And maybe you can combine that with what your outlook is for commodity prices.
Well, thank you. So this is a tip of my cap to a good friend in Houston that pointed this out to me. The U.S. right now imports about 6 million barrels a day of crude, and we export about 3 million barrels a day. So, folks probably don't recognize that we still are a net importer of crude. And the reason is that the refineries can't use all the crude that we produce in the United States, so we need to import heavier crude. And the other aspect of this is that the other way to think about it is we can't use all the crude that we produce in the U.S. Because the refineries can't take it. So if the U.S. were to ban exports, you would effectively take 3 million barrels a day of crude off the market, which doesn't make any sense. And I know that the energy executives have explained that to the administration. And then as it relates to natural gas, I just think it would set such a bad precedence if we would ever do such a thing. Natural gas right now, we're probably exporting, 10% or so of natural gas. But the thing is, we need good again, I shouldn't be on a soapbox, but the bottom line is we have abundant resources in the United States, and we should be able to export those resources and help out globally the world that needs our commodities. In terms of commodity prices, I think they stay relatively high. You could see a spike in oil prices because of geopolitical reasons. You also could see risk if COVID pops its ugly head again and demand falls off. But I'm relatively constructive. And I'd also point out, and this is not an original thought on my part, it's like Goldilocks. You don't want prices too high to shut off demand, and you don't want prices too low that you choke the industry.
Next here, how will the midstream companies prioritize their use of the free cash flow?
Well, the lessons that I think everyone's learned is that you need strong balance sheets. And the good news is that, balance sheets are pretty much where they need to be. So I think you'll see less of the free cash flow going to debt pay down, and more of the cash will be going to investors in the form of dividend increases and share buybacks. And then I think you also continue to see niche acquisitions where they make sense. But you should not underestimate the compounding effect of having that free cash flow being reinvested. And I think companies are going to remain disciplined in terms of how they spend their capital.
And lastly, Eve, given how well the energy sector has performed, is it still a good time to invest?
Absolutely. I really have strong conviction that that fundamentals are supportive. These companies will be generating, free cash flow. Energy is the only sector that comes to mind that is still trading. Well, the other way to say it, the energy sector is the only sector that still has room to get to new highs. So, I'm very constructive on the energy sector. I'm a big dividend guy. I think the income that the energy sector, in the form of dividends that provides investors, is huge. Valuations, as we pointed out, are very reasonable, and I think the narrative is changing. So I think energy, and again, I know I'm biased, but I think energy is just a really good place to invest. And I think people need to have a portion of their portfolio invested in energies. It's a shame that if you had zero energy exposure and the sector was up 55, generated a total return of 55% last year.
Thanks, Eve. I mean, that concludes the questions. I'll leave the participants here with your contact information. But if you have any concluding remarks, we'd appreciate it.
Yeah, the only thing, yes, what I'd like you to leave you with what I started. The decarbonization train, has left the station. It's a mega trend. It's not going away. But neither is oil and gas. And oil and gas is vital For one, because we just can't supply the energy with clean energy that we need. We need a reliable and affordable source of energy, and oil and gas is there. And then number two is you do want to be involved in the clean energy space, but you want to do it in a measured way. And I think we can do that, do both of that. And lastly, you should leave this with the understanding that the energy companies of today are generating significant amount of free cash flow. They're good stewards of capital, and they have their eyes wide open to the mega trend of decarbonization. And with that, thank you so much for letting me ramble for 40 minutes. And I apologize for running a little bit long, but feel free, as always, to give me a shout or email me. And again, thanks for joining us today.
Thank you very much, Eve. So with that, that concludes the presentation. I hope everyone has a great day and a great week.
Okay, thank you.